Off the coast of Dubai, the water holds a second planet. From the air, it is unmistakable. A scatter of beige continents carved to the outline of Earth, sitting in a rectangle of breakwaters. Africa is a comma of sand. Europe is a cluster of plots. Australia is a lonely oval. The project is called The World. Nakheel, Dubai's state-owned master developer, spent years and about $13 billion to dredge nearly 300 of these islands out of the Gulf. The pitch was simple. Buy a country. Build a nation of hotels, villas, and private clubs. By 2008, the sand was in place. The sales brochures were already old. Then look closer. A speedboat can thread the channels and hear nothing but the engine and the slap of water on unreinforced beaches. Survey stakes rust. Marketing flags are gone. On some plots, a lone excavator sits, as if the crew stepped away for lunch in 2009 and never returned. Most of those nations have no buildings, no working piers, no power cables that matter. A handful of islands carry real construction. A few villas, a European-themed resort that rose in pieces, a scatter of private houses.
More than 250 plots remain what the dredgers left behind. Bare sand. The islands did not sink. That rumor is lazy. The sand is still there, combed by wind, gnawed by current, held by rock. The brochure promised a private planet. The Gulf delivered a ledger of empty lots. What failed is a 2003 operating choice. Nakheel would build the foundations of an archipelago. Private investors would fund and finish the actual cities. When those investors lost their credit lines in the 2008 crash, the map froze. For nearly 2 decades, the most expensive cartography on Earth has been a maintenance problem. This is not a story about a city that vanished. It is a story about a company that completed the hardest physical work and still could not complete the project, because it separated the cost of making land from the cost of making a place.
Dubai did not stumble into this map. In the late 1990s, the emirate was already treating coastline as inventory. Oil would not last as a story. Aviation, ports, and tourism needed a skyline people could photograph from a plane window. In 2001, Nakheel began the Palm Jumeirah, a single engineered peninsula with a trunk road and a developer that kept a tight grip on the spine. The Palm proved that Gulf sand, dumped in careful layers and armored with rock, could become titled real estate. It also taught a dangerous lesson. If you can manufacture a palm tree, you can manufacture a planet. May 2002 changed the legal weather. Sheikh Mohammed bin Rashid Al Maktoum opened designated areas to foreign freehold. Suddenly, a plot in the water was not only a spectacle, it was an asset a non-Emirati could own, mortgage, and flip. Nakheel, operating under the Dubai World Commercial umbrella, needed the next product that would keep foreign capital arriving after the palm lots filled. In 2003, the company announced The World, 300 islands arranged as a planisphere 4 kilometers offshore, sheltered by a vast oval breakwater. Each island would carry a geographic name. Buyers would not purchase rooms. They would purchase Ireland or Sierra Leone or a sliver of Argentina. The operating choice sat underneath the poetry. Nakheel would finance and execute the marine civil works, dredging, reclamation, the common breakwater, the navigable channels. Private parties would buy raw islands and then fund hotels, desalination, power, sewage, marinas, and the last mile of armor against waves. On a spreadsheet, the logic is clean. Reclamation is a specialist, capital-heavy task. Vertical construction is a different risk, a different contractor market, a different taste in architecture. By delegating the second half, Nakheel could recycle cash from land sales instead of carrying the full cost of 300 resorts on its own books. The company would remain master developer of the sea, not landlord of every restaurant. Dredgers arrived from Europe. Cutter suction machines chewed the Gulf floor and sprayed slurry in high arcs, a method crews call rainbowing. Sand settled, dried, was compacted, and was shaped by GPS to look like continents from altitude. Rock for the outer breakwater came by barge. The work was competent. Later myths blamed the ocean. The engineering held.
What the public rarely saw was the contract structure riding on top of the sand. Sales contracts transferred development risk. Marketing suites in Dubai, London, and Moscow sold outlines, not operating hotels. Early asking prices ran from the high single-digit millions of dollars for smaller plots into the tens of millions for larger named countries. Brokers spoke of celebrity interest because celebrity interest is a solvent. Some names attached themselves to islands in the press. Far more buyers were consortia, holding companies and developers who intended to raise construction debt against a title that was, in practice, a beach with a name. Compare that with the Palm. On the Palm, Nakheel and its partners sequenced roads, utilities, and a handful of anchor hotels so that a resident could arrive to something that functioned. The world was designed as a constellation of private sovereignties. That was the product. Privacy, custom architecture, a neighbor who might be a different flag. It was also a coordination trap hiding in plain sight. An island is only a resort if boats, power, waste, and guests can reach it on a timetable.
Those systems are cheaper when they are shared. They are almost impossible when 200 owners must agree, in a downturn, to fund a grid none of them yet needs. By the mid-2000s, the physical map was rising faster than the institutional one. Nakheel could point to sand where a globe had been promised. Investors could point to contracts. What neither side possessed was a finished method for turning 300 separate ambitions into one working archipelago. The blind spot was not geological, it was commercial. The company had solved how to make land in deep water. It had not solved who would keep paying after the first payment if the world's credit engine stalled. The man most often placed at the center of Nakheel's expansion is Sultan Ahmed bin Sulayem. He was not a poet of sand. He was a commercial officer of Dubai's port and property machine, later the public face of Dubai World, the holding company that treated global terminals and local islands as related bets on trade and spectacle. His incentive was speed. A master-planned coast that took 20 years to fill would miss the window in which foreign money wanted a trophy in the Gulf. Selling named islands let him convert a dredging campaign into booked demand, while the cutter suction ships were still working. Above him sat the ruler's brief. Sheikh Mohammed did not need a lecture on diversification. He needed objects the world would repeat on television. An archipelago shaped like Earth is a sentence that writes itself in a news rundown. The political motive was attention that compounds into airlines, conferences, and second homes. The commercial motive was to keep Nakheel's land factory running after the obvious shoreline was spoken for. Between those motives lived a quieter one: prove that Dubai could manufacture scarcity. Natural beaches are finite.
Artificial countries can be listed, priced, and released in phases. On the other side of the table, the buyers were not a chorus. Irish developers arrived during the Celtic Tiger's last loud years, treating a plot called Ireland as both joke and brand. British and European investors saw a hedge against ordinary hotels. Russian and later various international names wanted privacy that a downtown tower cannot sell. Josef Kleindienst, an Austrian developer who would become the archipelago's most stubborn private occupant, bought into the European cluster with a different temperament. He intended to build a themed resort, not merely hold a deed. Most others behaved like land traders. Their hidden motive was leverage. An island purchased with a deposit and a construction facility is a call option on Dubai's story. If the story holds, you refinance. If it breaks, you stop pouring concrete. Nakheel's internal logic rewarded the first sale, not the 10th year of occupancy. Staff could be measured on plots moved, not kilowatt hours delivered to a villa that did not exist. That metric is not villainy. It is how a land company thinks when land is the product.
The life or death decisions were made in ordinary rooms. Decision 1. Transfer islands before shared utilities were real. Decision 2. Let architecture fragment so completely that no standard plant, no standard quay, no standard cable route could be ordered at scale. Decision 3. Treat the outer breakwater as sufficient public goods and leave each owner to finish the fight with waves on their own beach. Each choice reduced Nakheel's near-term cash burden. Each choice made the project fragile to a single global event. There was obsession in the model. The company had already shown it could bully geology. Delegating the rest felt like elegance, a refusal to become a hotel chain.
In reality, it was a bet that hundreds of private balance sheets would stay liquid on the same calendar. Ambition looked like restraint. Let the market finish what the state enterprise began. The market does not owe you a calendar or a crowd.
Through 2006 and 2007, the sales story still works. Cranes multiply on the mainland. Island prices are talked about as if they can only step upward. Some owners commission master plans. Architects draw private museums and six-star spas for plots that still lack a reliable power line. Contractors bid. A few early structures appear, enough for brochures to claim momentum. Then the credit system that made the second half of the model possible begins to lock. In September 2008, Lehman Brothers fails in New York, and the shock does not stay in New York. Trade finance tightens. Gulf property, which had been treated as a one-way wager, is repriced as a risk asset. Dubai's off-plan market, built on deposits and incoming loans, loses the incoming loans first. By 2009, mainland sale prices have fallen on the order of 50% from their peak, a collapse recorded by local indices. Buyers on the water are leveraged participants in the same market. Construction facilities are withdrawn. Letters of credit are not renewed. Credit committees in Europe stop treating a sand continent as collateral. Nakheel feels the same weather on a larger balance sheet. The company has obligations to contractors, bondholders, and the wider Dubai World Group. Projects across the Emirates slow. On November 25, 2009, Dubai World asks creditors for a standstill on roughly $59 billion of group liabilities. A Nakheel sukuk of about $3.5 billion, due in mid-December, sits inside that emergency. Markets had treated the paper as nearly sovereign. The standstill request is not a courtroom default on the first morning, but traders read it as a crack in the Dubai promise. Regional bank shares drop. Contractors already waiting on invoices stop waiting politely. Abu Dhabi later extends support that steadies the Emirates' credit. That intervention is about the federation, not about pouring guest rooms onto a plot named Chile. On the water, the delegated model now shows its geometry. An owner who still holds title cannot borrow to build because the island has no income and no utilities. An owner who wants to sell finds almost no bid because the next buyer faces the same dead grid. Nakheel still carries unsold inventory and the communal marine works. Empty islands do not become neutral. Unarmored beaches lose grains to longshore drift. Channels silt. The outer breakwater continues to take the worst of the Shamal winds, but each plot still needs its own revetment if it is to keep a designed shoreline. Protecting land that earns nothing is a pure cost. Aerial photographs in the early 2010s feed a global headline that the islands are sinking. The more precise fact is smaller and harder. Sand that is not completed as finished reclamation, not fully armored, not replenished, moves. The map blurs at the edges. Maintenance crews, when they are paid to exist, have to put the countries back. Lawyers replace architects. Files open over payment schedules, over whether a plot was delivered as promised, over who owes rock and who owes patience. Some buyers walk away from deposits they can no longer defend. Some hold and wait for the next boom, treating the deed like a ticket in a drawer. A minority keep building. Kleindienst pushes the heart of Europe on a northern cluster, importing a theatrical Germany, Sweden, and Switzerland, with indoor weather as a sales argument. Construction there is real and uneven. It is delayed, restarted, photographed, doubted, and photographed again. A few other shores show villas and private jetties. The rest of the atlas stays beige. Read the cash flows in sequence. Reclamation is a concentrated spend that Nakheel can award to a handful of marine giants and supervise as one campaign. Vertical work is 1,000 small spends that require each owner to raise debt, hire operators, and open to guests before the neighboring island even has a quay. In a boom, that fragmentation looks like creativity. In a bust, it is a row of unfunded mandates. Shared infrastructure has a cruel math. The first hotel to open must either overbuild a plant for neighbors who may never come, or live with expensive diesel and barged water. Either choice destroys the return the land price assumed, so even solvent owners hesitate. Hesitation is contagious.
The archipelago never reaches the density at which a regular ferry, a common power loop, or a waste network would make sense. Nakheel's restructuring through 2010 to 2012 keeps the company alive as a going developer of other Dubai districts. Survival on the mainland does not recapitalize the marine plots.
Staff still argue, inside budget meetings, for rock shipments to places with no keys and no guests. Every dirham spent on an empty beach is a dirham not spent on a project that can sell next quarter. That is the fiscal trap of leftover land in the sea. You cannot mothball an island the way you mothball a factory. Waves do not honor a pause. When Dubai's skyline recovers, trophies sell again on the mainland. This archipelago remains awkward because its unit of sale was too sovereign and too unfinished. Revival arrives as fragments. Kleindienst markets further phases and announces dates that slip. The Business Times reports that children of a Dubai billionaire are preparing to restart Stalled Islands, a family office sequel. Private capital again asked to complete a map a state developer framed. The pattern repeats. A well-capitalized believer buys a group of plots, unveils a rendering, and discovers that an archipelago is not a lot. It is a system of neighbors, channels, permissions, and shared invoices. A single finished villa proves one committed balance sheet can defy the average. It does not summon the missing neighbors. The Gulf keeps charging rent on geography that still has no street. A coastline can be sold before it is a place. That is the modern temptation, and the world is only its clearest drawing. When a developer pours the foundation of a city and then auctions the right to finish the rooms, two clocks start. The sea's clock is patient and expensive. The credit clock is nervous and short. If those clocks disagree, you do not get a delayed city. You get a permanent construction site with no construction, a public-looking object that is privately unfinished, a maintenance contract dressed as a destination. The lesson is narrower than a sermon about greed. Integrated megaprojects fail too. Palm districts have had their own lawsuits, delays, and empty units. The specific risk here is the cut between layers. Reclamation is a monopoly task. Hospitality is a competitive task. Binding them with nothing but a sales contract assumes that hundreds of owners will voluntarily rebuild the monopoly where it matters. Power, waste, access, armor. Markets are good at pricing a view. They are bad at volunteering for a power station that mostly serves someone else's island. So the rational owner waits. Waiting, multiplied by hundreds, is indistinguishable from abandonment. Delegating development feels, in a boom, like humility. The master planner refuses to dictate every balcony. In a drought of credit, it is something colder, a transfer of the hardest years onto people who cannot print money and cannot move the island back to the mainland. States can wait. Private borrowers have covenants. That mismatch is the mechanism. It will keep appearing wherever a government-linked firm manufactures a spectacular platform and invites the world to finish the rooms. Ports and district energy grids repeat the shape. Sell the platform, pray the tenants capitalize the last mile together. The prayer is not a strategy. Empty engineered land is not wilderness. It is a machine that must be fed rock and diesel, or it loses its shape. Someone pays for that feeding, even when no guest pays for a bed. The cost can be socialized into a state developer's budget, hidden in a holding company's accounts, or postponed until a storm makes the postponement visible. None of those choices appear on the original brochure. The brochure sold a country. The ledger sold an obligation. Stand on a finished Dubai beach at dusk, and the skyline looks inevitable. That inevitability is the trick. Most of what you see was sequenced so that roads, current, and customers arrived in the same decade. 20 minutes out to sea, the other map still asks a question the first map evaded. If you can manufacture land, who is responsible for the years when no one lives on it? The islands will likely see more renderings, more family offices, more ceremonial first piles. Some clusters may even work. Success on a dozen plots would be a hospitality story. It would not erase the operating choice that left a planet to wait on other people's loans. A night photograph from a jet still catches the outline, a pale cartoon of Earth. Passengers point.
very few of those passengers will ever step onto the beaches they just named. The water between the continents is calm on a good afternoon, a bright geometry, almost playful. Then the wind lifts, and you remember that every edge is a negotiation with erosion. Who keeps paying for a map that almost no one inhabits?